If your portfolio is bigger today than it was 2 years ago, you've probably told yourself the same thing I hear in almost every comment section on this channel. I'm finally in good shape. I can relax a little. Here's the uncomfortable part. That growth might be the exact reason you're less protected from a crash than you were before, not more. Not because the market is about to crash tomorrow, because of 3 specific documented mechanisms from the S&P index rules themselves, from federal margin lending data, and from the IRS tax code that are quietly working against you right now today, while your account balance looks great. Most videos on this topic just tell you to diversify and move on. I'm going to show you the actual machinery, with the real numbers behind it, and then give you one number you can calculate for your own account tonight that tells you exactly where you stand. Here's where we're going. First, I'll show you why the very index fund you think is protecting you has quietly turned into one of the most concentrated bets in stock market history, and I'm calling this one the passive concentration trap. Second, I'll walk you through what I'm calling the borrowed growth problem, because a chunk of the growth showing up in accounts across the country right now isn't even the investor's own money. Third, the lock-in cage, which is the part almost nobody talks about, where the tax code itself gives you a reason to stay dangerously concentrated instead of fixing it. Then I'll give you the formula. It's called the look-through number, and it takes about 2 minutes to calculate for your own portfolio, no matter what size it is. Let's get straight to the answer, because you don't need to wait until the end of this video to hear it. Your portfolio's dollar growth and its actual crash protection have been moving in opposite directions for the last few years. Growth and protection used to move together. If your account went up, you probably owned more companies, spread more evenly, so a hit to any one of them barely showed up in your total. That relationship is broken. The mechanism that made your account bigger is the same mechanism that made it more fragile. I know that sounds like a contradiction, so let's break down exactly how it works. Starting with the fund most people think is their safety net. The passive concentration trap works like this. The S&P 500 isn't 500 equal slices of the economy. It's weighted by size, so the biggest companies get the biggest slice. And when those companies keep winning, the index automatically funnels more new money into them. As of the most recent data, the top 10 companies in the S&P 500 make up roughly 40% of the entire index's value. Just 7 of those companies, the group everyone calls the Magnificent Seven, account for somewhere around 30 to 34% on their own. There's a way to measure this mathematically called the Herfindahl index, and when analysts ran that math on the S&P 500's actual holdings, the index behaved statistically like it only held about 54 stocks, despite technically containing 503 of them. You bought a fund with 500 names in it. You're carrying the risk profile of about 54. Here's why that matters for the fear we started with. If you felt good about your portfolio growing over the last 3 years, a meaningful chunk of that growth came from exactly these same 10 or so companies rising together, tied to the same story, mostly artificial intelligence spending. When 10 stocks that are all riding the same narrative make up 40% of your diversified fund, they don't behave like 10 separate bets anymore. They behave like one big bet with 10 tickers on it. Your fund got bigger because it got more concentrated, not because it got safer. That's the trap. It doesn't feel like a trap while it's working in your favor, which is exactly why almost nobody notices it until the story turns. That's the first mechanism, and it's already enough to worry about on its own. But there's a second one stacking right on top of it, and this one involves actual borrowed money, which changes everything about how a crash plays out. The borrowed growth problem starts with a number that should stop you cold. FINRA, the regulator that tracks this stuff across every brokerage in the country, reported that margin debt, meaning money investors have borrowed against their portfolios to buy more stock, hit a record $1.42 trillion in the most recent reading, up over 53% from a year earlier. Compared to the size of the overall economy, that puts margin debt near a 50-year high relative to GDP. Some of your portfolio's growth, and some of the growth in the broader market pushing your index fund higher, is quite literally sitting on borrowed money that has to be paid back regardless of what the market does next. Here's the part that turns this from a statistic into a mechanism. When prices fall and an account's value drops below what the broker requires, the investor gets a margin call, and if they can't cover it, the broker sells the stock for them, automatically, at whatever price it can get. Picture someone who borrowed against a portfolio to buy more shares of the same handful of popular names everyone else owns. A 10% drop in those names doesn't just cost that investor 10%. It can wipe out most or all of their own cash in the position, since the borrowed money loses value right alongside their own, and the broker doesn't wait around for a recovery before demanding it back. That forced selling pushes prices down further, which triggers more margin calls on other accounts, which forces more selling. It's not a theory. Every major market peak in the last 100 years, 1929, 1987, 2000, 2007, and 2021 happened alongside a record in margin debt right before the drop. The size of your own portfolio, whether it's $50,000 or $500,000, doesn't shield you from this. If the broader market gets caught in a leverage unwind, everyone holding the same popular stocks gets pulled down together, borrowed money or not, because that's how a shared crash works. You don't need to be the one who borrowed a cent for this to hit you. You just need to be holding the same crowded stocks as the people who did. So now you got two forces working against you at once. Your fund is quietly concentrated in the same handful of names, and those same names are partly propped up by a record amount of borrowed money. You'd think the obvious fix is simple. Sell some of the winners, spread the money out, done. This is where the third mechanism shows up, and it's the one that explains why smart, careful people don't just fix this even when they know about it. The lock-in cage comes straight from the IRS. Under the tax code, you don't owe a dime of capital gains tax on a stock's growth until you actually sell it. That sounds like a nice deal. And it is, right up until you realize what it does to your behavior. Say you put $10,000 into one stock a few years back and it's now worth $40,000. That $30,000 gain is only taxed the moment you sell, at long-term capital gains rates that can run up to 20% depending on your income. Sell it all to fix your concentration, and you could be writing a check to the IRS for several $1,000s this year, out of your own pocket, just for the privilege of being properly diversified. So people don't sell. They tell themselves they'll rebalance later, next year, after the next raise, and the position just keeps growing as a share of the account because nothing else in the portfolio is growing quite as fast. Researchers at Yale's Budget Lab have a name for this pattern. They call it the lock-in effect. And they specifically point out that it creates a strong incentive to keep holding an already oversized position, even when the investor would genuinely prefer to diversify. It's also exactly why so many wealthy investors borrow against their stock instead of selling it, which loops directly back to the margin debt problem from a minute ago. The tax code is quietly rewarding you for staying concentrated. Three separate institutions, the people who run the index, the regulator who tracks borrowed money, and the IRS, are all pointing the same direction. Growth without a plan tends to concentrate you, not protect you. Before I give you the formula, I want to head off the fix a lot of people jump to here, because I see it constantly in the comments on this channel. I'll just add some REITs, real estate investment trusts, since everyone says they're a great diversifier. They can be. Nareit, the industry group that tracks this data, has shown that REITs historically carry a lower correlation to regular stocks, and REIT dividend yields right now are running close to 4%, compared to a little over 1% for the S&P 500 itself. That's a real sourced advantage for a specific kind of risk, the risk that your one particular sector or your one particular company craters, while the rest of the market is fine. What REITs don't protect you from is interest rate risk. In 2022, when the Federal Reserve hiked rates aggressively, the FTSE Nareit All Equity REITs index fell about 25%, nearly as badly as stocks did that year, because REITs are sensitive to rates in a way ordinary companies aren't. Adding REITs fixes one specific kind of concentration. It does nothing for the borrowed money problem or the tax lock-in problem. You need to know which mechanism you're actually solving for, not just throw a popular ticker at the whole issue and call it handled. Okay. Here's your number. It's called the look-through number, and the idea is simple. Most people check diversification by counting how many different funds or tickers show up on their statement. That number lies to you because of the passive concentration trap we just covered. What actually matters is how much money you have riding on your single biggest underlying company once you look through every fund you own to see what's really inside it. Here's how you calculate it. Step 1. Find your total portfolio value across every account. Step 2. For each stock fund you own, check its top holdings weight. Most brokerages list this, or you can find it in seconds searching the fund's ticker, plus the word holdings. Step 3. Multiply that weight by your dollar amount in that fund to get your look-through exposure to that single company. Step 4. Add up your look-through exposure to that same company across every account and every fund you own. Step 5. Divide that total by your overall portfolio value and multiply by 100. That's your look-through number, the real percentage of your entire portfolio that depends on one company's stock price. Let's run 3 quick sizes so you can see how this plays out. Someone with a $50,000 portfolio, fully in a plain S&P 500 index fund, with the largest holding sitting around 7% of that index, has a look-through number of about 7. Someone with a $150,000 portfolio, split between an S&P 500 fund and a separate position in that same top stock, because they like the company individually, might be looking at a look-through number closer to 11 or 12, without ever noticing they doubled up. Someone with $300,000 heavier in a tech-focused fund on top of the S&P 500 position can easily cross 15 or even 18. None of these people did anything reckless. They just never ran the math because their statement showed 500 company names and felt diversified on its face. There's no single correct answer here because your number depends on your goals and your stomach for risk. But the research on this gives you a real anchor. Statman's classic study on diversification found you need at least 30 to 40 individually selected stocks to meaningfully reduce single company risk. And more recent research pushed that closer to 50, since individual stocks have gotten more volatile relative to each other since the 1990s. A portfolio spread evenly across 50 stocks would put about 2% in any single name. If your look-through number comes back at 7, 11, or 18%, you're carrying 3 to 9 times the single company exposure that real diversification implies. And now, you know it in a real number instead of a feeling. Let's bring this together. The passive concentration trap showed you why a fund with 500 names can behave like it only holds 54, because the biggest winners keep pulling in the biggest share of new money. The borrowed growth problem showed you why a chunk of that growth is sitting on a record amount of margin debt, over $1.4 trillion of it, that has to unwind eventually the same way it always has at every major peak. The lock-in cage showed you why the tax code quietly talks you out of fixing either one, since selling to fix your concentration means paying the IRS in cash today for a problem most people would rather ignore until later. And the look-through number gives you the actual figure that ties all three together for your own account tonight, in about 2 minutes with a calculator, no matter whether your account sits at $50,000 or $500,000. So back to where we started. Your portfolio being bigger doesn't automatically mean it's safer. It might just mean it's more exposed, wrapped in the comfortable feeling of a rising balance. Now you know the 3 reasons why, and now you have the number that tells you where you actually stand instead of just guessing off how good your account looks on the screen. Before you go, drop your look-through number in the comments. I want to know what percentage of your entire portfolio is riding on your single biggest holding, because I'd bet a lot of you are about to be surprised by your own math. If that number came back higher than you expected, don't go guess buying random tickers to fix it. I already built the actual framework for putting a real diversified income portfolio together, tier by tier, using the dividend pyramid I laid out in The Best ETFs to Live Off Dividends in America. That video shows you exactly which funds belong in which tier and why, so you're fixing this with a plan instead of just scattering money around and hoping. Go watch that one next, and let's get your number down where it should be.